The collapse of FTX was a huge shock to the crypto community. A few years prior to its conception, FTX decided to shut down all operations. For those who are unfamiliar with FTX, it was a crypto exchange that allowed users to trade cryptocurrencies like Bitcoin and Ethereum. For more primary details regarding FTX and the issue at hand, do watch our previous video linked in the description. If you already did, then continue watching because the topic will just get much spicier. Please consider liking and subscribing, especially if you like this type of content. We always appreciate any kind of support. Welcome to EM3 Financial Freedom Strategies, where you learn how to manage your time and money to achieve financial freedom. If you want to know all the juicy details, then make sure to watch until the very end. Recapping the information from the first video, everyone by now should know that FTX and Alameda Research work hand in hand. This is to the point that whatever happens to the other will heavily impact the other. He first created Alameda in order to engage in cryptocurrency arbitrage trading, and he then created FTX in order to provide a more advantageous platform for Alameda to trade on. After taking out loans that may have been financed by funds from FTX clients, Sam Bankman-Fried's trading company Alameda Research is said to owe his cryptocurrency exchange FTX up to $10 billion. Basically, this also means he used that much money from customers' pockets to fund his other business operations. Alameda reportedly utilized the money that FTX allegedly loaned to them, which is more than half of the client funds, to place bets on other cryptocurrencies and support failing cryptocurrency companies. According to Reuters, after being severely impacted by the collapses of Three Arrows Capital and Voyager in May of this year, FTX loaned customer assets to Alameda Research. Given a few odd events that occurred during the summer, such as prominent financial YouTubers advising their audiences to retain their cryptocurrency at FTX rather than in other wallets they don't usually use, it is possible that something terribly wrong happened around that time. Of course, this raised concerns about whether or not their money was safe or if the company was going to crash or go through another crisis. Still, the actual fact remains regarding people who were convinced to put their trust and money in FTX and subsequently suffered financial hardship due to the loss. Only a few weeks ago, FTX was evaluated by its investors at $32 billion. But now that the company is insolvent, it seems to be worthless. How did this come to be in such a small period? You know about FTT, right? In contrast to purchasing an asset with significant security, these tokens do not come with any guarantees from FTX regarding ownership or dividends. Instead, you receive benefits like trade discounts. It's crucial to note that FTX has promised to repurchase FTT tokens with a percentage of its earnings from profits. As a result, the token now functions something like a stock in FTX. This means that the more lucrative the company becomes, the more of these tokens FTX buys back, and the higher the price will go. This FTT token operates similarly to a stock in that it is anticipated to climb and decrease together with how profitable the trade is. Later in June this year, Alameda Research was reported to have assets worth $14.6 billion. However, its largest assets included FTT valued at $3.7 billion and FTT collateral valued at $2.2 billion was its third largest asset. Looking at the liabilities section in their balance sheet, loans were listed at a whopping $7.4 billion. The worst part is they used FTT as collateral. From a risk viewpoint, This is essentially a disaster if the collateral supporting its loan starts to decrease in value. Changpeng Zhao, famously known as CZ, the CEO of Binance, declared on Twitter that he will liquidate his FTT shares as a result of these new findings as word spread about Alameda's financial sheet. As a result of CZ's statement, the price of FTT fell, and traders hurried to sell their holdings in FTX out of concern that the company would fail. The price of FTT continued to drop afterward. Since FTX operates like a bank, if customers simultaneously withdraw their money, then they will suffer a huge problem related to liquidity and solvency. To be clear, a liquidity problem occurs when a company has enough cash on hand but is unable to access it fast enough. However, this does not mean that the money is wholly gone. It just means that they won't be able to take it immediately. On the other hand, a business has a solvency issue when it has simply lost money. Liquidity issues can develop into solvency issues since selling off assets fast to address a liquidity issue will drive the value of those assets lower. A liquidity issue has now turned into a solvency issue as a result of the selling pressure pushing the worth of the assets underneath the worth of the liabilities. In light of this, Mr. Bankman-Fried asserted that FTX was just illiquid at that time, but not insolvent to appease the masses. Obviously, most investors did not buy into his story and instead continued to dump their FTT. Someone could theoretically intervene and stabilize the situation at FTX if the problem is only one of liquidity. However, seeing Binance back out of buying FTX, then the problem shouldn't only be that of liquidity. If clients' money has been loaned out, consumers of FTX appear to be in danger of losing a sizable portion of their money unless Mr. Bankman-Fried is successful in finding a buyer, which is becoming more unlikely. It should also be known that there is a controversial statement from Kevin O'Leary, a well-known Canadian businessman and TV personality, about FTX's bankruptcy. He claims that Binance put FTX out of business deliberately. To be exact, he said, quote-unquote, "These two behemoths that own the unregulated market together and grow these incredible businesses in terms of growth were at war with each other, and one put the other out of business intentionally. Now maybe there's nothing wrong with that. Maybe there's nothing wrong with love and war, but finance is a massive unregulated global monopoly now. They put FTX out of business." This implies that two giants of exchanges are battling for supremacy in the market, and one of them, to gain a monopoly in the crypto scene, was bent on destroying the other by any means necessary. What do you all think of this statement? Does what he said seem right to you? You're welcome to share your thoughts in the comments down below. Hopefully this video helped shed some light on this matter. The event regarding FTX definitely gives some tidbits to think about regarding the future of crypto. What regulations should be implemented? How can we avoid another situation like this in the future? These questions pile up as time goes by, and hopefully they get answers soon. As always, we in EM3 wish you the best of luck. In the meantime, we hope you enjoyed watching this video, and don't forget to give a thumbs up if you liked it. Please subscribe if you haven't done so already to see more of our content. If you liked our content, then please check out our other videos. Thank you for watching and see you in the next video.